Welcome back to The Explainer. Today, we're diving into something deeply fascinating. If you follow real estate, you know the market is always shifting. It's always telling a story about human behavior and economics. But the July 2026 residential real estate report for Montreal, well, it's telling a story that might just make you do a double take. It's a genuine market paradox, and we're going to unpack exactly what the data is trying to tell us. I want to pose this opening paradox to you right off the bat. So think back to your high school economics class. Conventional wisdom, basic supply and demand, tells us that if fewer people are buying homes and there are more homes sitting on the market to choose from, prices should inevitably drop, right? Buyers get picky, sellers get desperate, and values come down. Well, as we're about to see in this explainer, the Montreal data reveals a very surprising twist to that textbook theory. Let's start with the first piece of our puzzle, negative 16%. This represents the massive dive in total sales volume compared to July of last year. Over in the centrist system, they logged just 1,198 total sales for the month. That is a significant, undeniable slowdown in the sheer number of keys changing hands. Buyers have clearly pulled back. But wait, we immediately have to contrast that drop in sales with a massive surge in inventory, positive 15%. So while sales basically fell off a cliff, active listings, the properties sitting available on the market, have actually surged by 15% year over year, hitting 10,493. We have a crystal clear supply and demand contradiction staring us right in the face. Less buying, but a whole lot more selling. Okay, let's dive into this. To unpack this mystery, we're going to look at the data in 4 quick steps. First, supply, demand, and sales. Second, property prices continue climbing. Third, breaking down property types. And finally, negotiation and market time.
Section 1. Supply, demand, and sales. Let's unpack the inventory shift.
Looking at the official residential market summary for July 2026, you can clearly see exactly what we're dealing with here. Over on the left side of the screen, you've got that dark blue bar for July 2026 sales sitting noticeably lower than the previous year, registering those 1,198 sales. And right below it, that massive 10,493 active listings figure. Visually, the gap is just striking. Now, before we get too far ahead of ourselves, I want to briefly clarify what we mean when we say active listings according to the centrist system, just so we're all on the exact same page. The report defines this strictly as the number of listings having an active status on the very last day of the month. It's basically a snapshot. It is the truest measure of available inventory at that specific moment in time. What's really wild here is the widening gap between active buyers and fresh inventory. Not only are total active listings up, but new listings, properties just entering the market, actually increased by 3% year over year to 2,299. So you have a shrinking pool of buyers, but a steadily growing number of newly listed properties flowing into the system every single day. Moving to Section 2, property prices continue climbing. This is the twist in the data. An absolutely crucial point here is understanding how we measure this. The real estate board relies on the median price, not the average. If you take all the sales in July and line them up from cheapest to most expensive, the median is the one exactly in the middle. 50% of homes sold for less and 50% sold for more. This prevents a few ultra-luxury, multi-million-dollar mansions from artificially skewing the numbers, giving us a much more accurate picture of what a typical buyer is actually experiencing. Let's look at the ultimate proof of our market paradox. This summary table proves that prices are universally up. Checking out the median price column, single-family homes jumped 7% to $817,500. Condominiums ticked up 2% to $480,000, and plexes, those 2 to 5 unit income properties, saw a massive 9% spike to $910,000. So despite all that extra inventory, the market is broadly and firmly valuing properties higher than it did a year ago. Now, I always like to throw in this crucial disclaimer pulled directly from the explanatory notes of the report. It reads, "Caution, the median property price is based on transactions concluded via the centrist system during the selected period. It does not necessarily reflect the median value of all properties within a given area." This is just a fantastic reminder to interpret these statistics carefully. I mean, if a bunch of highly renovated homes happen to sell in one specific month, the median jumps. But it doesn't automatically mean your unrenovated neighbor's house is suddenly worth 9% more. Context is always key. Let's transition to Section 3, breaking down property types. Time to get into the granular details. Breaking this down, plexes are absolutely leading the pack in sheer value, sitting at $910,000. That 9% jump we mentioned, that is the strongest price growth in the residential sector right now. Single-family homes sit solidly in the middle at $817,500. Condos remain the most accessible entry point at $480,000, but hey, even they saw a modest 2% gain. But what's really fascinating is looking at the sales volume drop between these property types. Single-family home sales only dropped a relatively modest 5% year over year. There were 387 of those sold. But the condominium market, it took a massive 22% hit in sales volume, dropping to just 582 transactions. So while prices for condos are technically stable, the actual appetite and volume of condo trading has slowed down drastically compared to single-family housing.
Finally, Section 4, Negotiation and Market Time, the reality on the ground.
To figure out the reality of market pacing, we look at average days on market. The board defines this simply as the average number of days between the date a property is listed and the date a promise to purchase is officially accepted. It tells you exactly how long you should expect a transaction to take and whether the market is moving at a frantic sprint or a leisurely stroll.
Just look at the pacing of the market today. Single-family homes are moving the fastest, taking an average of 45 days to secure an accepted offer. Plexes are right behind at 48 days, which is actually 9 days faster than last year. But look at condominiums. They are sitting significantly longer, averaging a full 60 days on the market. That's 2 straight months of showings before a seller secures a buyer.
Now for my absolute favorite metric, price negotiation. The board measures this as the ratio between the selling price and the asking price. Basically, are homes selling for what the seller wanted? Are they going for a discount? Or are buyers paying a premium in a crazy bidding war? They break this down into 3 categories: over asking, asking price, and under asking. The current reality is honestly stark. Let's look at single-family homes. A vast majority, 72%, are selling right at the asking price. That means sellers are pricing accurately and holding firm. The days of widespread, frantic bidding wars are essentially over. Only 5% of homes sold over asking, and 22% managed to negotiate a deal under asking. The big takeaway? Buyers definitely have some room to breathe, but sellers are absolutely not slashing their prices just because inventory is up. So why can sellers hold firm? It all comes down to a concept the board tracks called overheating. The official definition is when demand significantly and persistently exceeds supply, causing upward pressure on prices. While demand has certainly softened by that 16%, the historical context of the Montreal market means the overall conditions still favor sellers just enough to maintain that upward pressure. The imbalance hasn't corrected quite enough to flip the power dynamic fully over to the buyers. Which leaves us with this final, provocative thought to end our explainer today. We have rising inventory. We have fewer sales. Yet, sellers are getting their asking price, and median values are up across the board. The basic mechanics of supply and demand are literally being stretched. So can this resilient, somewhat overheated pricing trend sustain itself as we head into the fall market? Or is this the absolute peak before gravity finally takes hold? It's a wildly fascinating time in Montreal real estate and something you will definitely want to keep a close eye on. Thanks for joining me on this deep dive into the numbers.